Hi folks, Chuck Gibson from Financial Perspectives in San Ramon, California with May 2017's Charts on the Move. I'm going to spend this entire video highlighting something I've been watching that started to unfold a year or more ago and has recently picked up steam, and as such, it has my attention. Those that are longtime listeners know I've pounded the table for anyone listening to make the case for keeping most, if not all of your stock assets within the U.S. markets. This wasn't because of some prejudice I had, but rather because the U.S. stock market was in a long-term secular uptrend versus just about every other foreign market around the world. It was one of the rare times it made no sense to globally diversify unless performance was not a concern. But it appears as if all that may be changing and this secular trend may be coming to an end. They all do, it's just a matter of time. Let's take a look at some charts of stock markets around the globe. I'm going to spend extra time on this first chart describing in added detail because all subsequent charts are set up exactly the same, which should allow us to get through them relatively quickly. All charts include 7 years worth of historical data reflecting a weekly close. Let's kick this one off with one of the most important stock market indexes outside the US, the London Financial Times Stock Exchange, otherwise known as the FTSE 100. In the upper pane, as I normally show, is RSI price momentum, which will not be a part of these discussions, as I plan to focus solely on price action. In the middle pane is the price of the FTSE index and includes a red 200-day moving average. We use this 200-day moving average to help identify the longer-term trend, but like RSI momentum, I will not be utilizing it today. In the bottom pane is where we'll be spending the bulk of our time reviewing, as it's the ratio of the FTSE index performance against the US S&P 500 index. When looking at the two charts without a handy comparison tool, it might be hard to distinguish which investment is the better choice, especially when both are moving together. The beauty of looking at the ratio is that it acts as this comparison tool and helps identify the better performing investment simply by looking at its direction. In the case of the FTSE, in June of last year, the ratio bottomed and eventually went on to break and stay above this red downtrend line. While it has fallen back some against its highs, it continues to demonstrate relative outperformance from the last year's bottom. During this long, almost 7 years of extended underperformance, the FTSE's returns have lagged those of the S&P by almost 40% total. Clearly, there was no reason to be invested in the London market during this period, but you wouldn't have known this until after the fact if you didn't look at the relative performance ratio. The interesting takeaway here is that it looks as if it may be, just maybe, that long-term secular trend may be coming to an end. Only time will tell, but the rounded bottom shape and the higher highs are typically a good first sign that a bottom may be in. Like London, the similarly important Hong Kong stock market is telling a similar story, but with just slightly different timing. The ratio found a recent bottom in December of last year and has broken above the red downtrend line just recently in May. This is a start, but as you can see, the ratio is yet to make a series of higher highs and higher lows. In spite of that though, the Hong Kong market has underperformed the S&P 500 by only 10% over the past 7 years, which is just a bit more than 1% a year. As you'll see, it has been one of the best performing markets next to the S&P 500. My next chart of South Korea's Kospi stock composite shows a market that has been range bound for more than 6 years, but recently broke out to new highs, which I wrote about a few weeks back. A breakout to new highs confirmed from an extended base on significant volume, well, that presents a compelling and typically very profitable buying opportunity. But on that breakout, the ratio, while breaking out of its downtrend line, it still has yet to make a higher high or higher low, which would be the additional confirmation a directional change has taken place. The ratio tells us there has been no reason, and there still doesn't appear to be one, to commit money to this market. But it could easily change in the coming weeks, and is why I'm watching this movement so closely. The prior two charts were some individual Asian country markets, but taking a look at the composite of the largest Asian markets, excluding Japan, well, the story's still the same. Like the others, this index has lagged the US market, this one by 50%, and found a near-term bottom and broke out from that multi-year downtrend. Well, it looks slightly better than the Korea's Kospi, as it has almost made the requisite higher high, but not quite, but it is ever so close. If it did, it would be a huge step in the direction I would need to allocate money out of the US and into Asia. Moving over to an aggregate look at Latin American stocks, we see that they too bottomed last year, except very early in the year. After breaking above the multi-year downtrend, they are in a slow, grinding move sideways, testing the prior high. A move above were what I would want to see before moving investment capital into this area because, as you can see, it has been a long-term disaster, lagging the U.S. stock market by more than 70%. Ouch. The emerging market index, while not as bad as Latin America, have also massively underperformed the U.S. index too, as they have lagged 57%. The emerging markets bottomed a bit earlier in January of last year, but only just recently broke out from its downtrend in March of this year. Since bottoming, it has constructively created higher highs and higher lows. The potential that the emerging markets are breaking out against the U.S. is a powerful signal that money is rotating out of the U.S. and into other areas of the world. An aggregate look at Europe tells a similar but not quite as compelling tale just yet. The index bottomed in November of last year and has since formed higher highs and higher lows, but is yet to break out from its long-standing downtrend line. While I put less credence in an angled support resistance line, a breakout would be what additional level of confirmation I would prefer to see. Notice that while still a laggard, Europe has fared better than the less developed markets, lagging the US index by 38%. So while I did not show you every market around the globe, I think it's obvious from the major markets I did present that there is a potential change afoot. If true, this is a big deal and has a huge implications for investors. The ongoing U.S. stock market outperformance is at risk. The need for diversification may be back. These potential secular changes don't occur overnight and can take months and sometimes years to unfold. Additionally, in their early stages, they can provide a number of contradicting signals challenging your resolve. With that being said, there is one huge obstacle that could throw this whole thesis of buying foreign on its head. The 800-pound gorilla, well, it's the US dollar. It would be very difficult for foreign equities to significantly outperform if the dollar is rising. As we know, foreign stock performance is inversely correlated to the dollar, so it will be crucial for the dollar to cooperate and fall in value if we are in fact entering into a secular period of foreign stock outperformance. To look for a clue, my last chart is that of the US dollar. This is a 32-year look back at the price of the dollar. You can see from its bottom in 2008, which was almost again retested in 2011, the dollar, while not straight up, has had an upwards trajectory until it began its current sideways consolidation in 2015. Notice also the retest of the bottom in 2011 was the starting point in which most foreign stock markets started to underperform. It should come as no surprise and probably very obvious when you think back on all the prior charts I presented. Their recent bottoming began right after the dollar peaked and begun its current consolidation. The bottom line here is the dollar holds the key to foreign asset exposure in your portfolio. If you were to stick a gun to my head and force me to lay down a bet, I'd have to bet that we will eventually see this consolidation as nothing more than a false breakdown signal. This is because when in consolidation, the eventual break will have a higher probability to be in the direction of the prior trend. If this holds true, the dollar isn't done rising, and is why I have hedged this entire video when speaking of U.S. stock outperformance trend ending with the word potential. But my opinion shouldn't preclude you from starting to dip your toes into foreign stock market exposure in case the dollar has topped, because that's exactly what I've been doing of late. Until next month, as always, appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with May 2017's Charts on the Move.